Some of the best performing investments in the world aren't found on the stock exchange. Not because they're secret, but because they're private by design. For decades, private equity has been the engine behind institutional outperformance. Think of Yale's endowment, Canadian pension funds, sovereign wealth vehicles. Their edge wasn't timing markets, it was stepping away from them, investing in companies directly, improving them, and building value from the ground up. Now, that world, once limited to billion-dollar funds, is slowly opening to individuals. But with access comes a harder question. Just because you can invest, should you? Let's break that down. What is private equity really? Private equity means buying ownership in private businesses, companies not listed on public stock markets. You're not buying shares from another investor, you're buying into the business itself. Often you invest alongside experienced operators or institutional capital. In many cases, you help shape what that company becomes. There are several types. Buyouts, taking control of mature businesses and improving operations. Growth equity, funding fast-growing companies before they go public. Venture capital, backing early-stage startups with high risk and high upside distressed assets, acquiring troubled companies and turning them around. Secondaries, buying into existing private equity deals partway through their life cycle, often at a discount and with shorter lockups. Each strategy has different risks and time horizons, but they share one trait. In private equity, value isn't found, it's built. Why do institutions favor private equity? According to sources like Cambridge Associates, between 2000 and 2020, private equity outperformed the S&P 500 by 300 to 500 basis points annually, depending on the strategy and fund vintage. That might sound small, but over time the gap compounds fast. A $1 million investment at a 14% return grows to about $3.7 million in a decade. At 9%, it's closer to $2.4 million. Same capital, different discipline, very different outcome. Here's why. Private equity managers buy with discipline, not hype. They control operations. From hiring to strategy to margins, they exit with precision, not emotion. They're not riding the market, they're engineering results. Still, keep this in mind. Past performance doesn't guarantee future returns. So what's changed? Why are individuals getting access now? Historically, private equity was a closed circle. Minimums of $10 million kept most investors out, even family offices. But today, feeder funds pool capital, letting individuals invest with $100,000 to $250,000. Platforms like Moonfare, iCapital, and CAIS give access to vetted funds. Secondaries offer quicker exits, often at discounted entry. Syndicates provide direct access through curated networks. The result? Lower entry points, more visibility, a new door for individual investors. But here's the key. Access is not equal to advantage. Just because the gates are open doesn't mean the field is level. Private equity still favors those who understand the rules and the risks. Should private equity be in a high net worth portfolio? Let's examine 4 core reasons serious investors consider it. 1. Return potential. Top-tier funds often target net internal rates of return, IRRs, of 12% to 18%. Even middle-performing funds may beat public benchmarks. This isn't about chasing alpha, it's about building a margin of safety, returns that protect long-term goals if other parts of your portfolio underperform. Second, diversification. Public markets often move together in a downturn, but private equity behaves differently. Because assets are privately held, priced quarterly, and actively managed, they're structurally less correlated. That doesn't mean no risk. It means different risk. 3. Access to untapped growth. Much of today's innovation, inefficiency, and growth happens before companies go public. Private equity lets you get closer to where real value is being built, not where it's already priced in. 4th, control over outcomes. Public ETFs can't reduce costs or hire better leadership, but private equity funds can and do. When you invest in PE, you're not just exposed to market shifts. You're aligned with management strategy. Private equity isn't plug and play. Before investing, ask yourself, can I lock up capital for 7 to 10 years? Do I understand the strategy? Buyout, venture, secondaries? Am I accessing top-tier managers or just available ones? What's the fee structure? Management fees, carried interest, platform costs? Does my tax advisor understand private structures and K-1s? How does this fit with my liquidity needs and risk tolerance? Even a well-performing fund can create issues if it misaligns with your broader planning. This is not a mutual fund. It's a long-term capital commitment. Private equity may not suit every investor. It involves risk, illiquidity, and complexity. Due diligence and professional guidance are essential. But if it does fit, it's a different way of thinking. Less liquidity, more intention, less noise, more control, less chasing, more crafting. In public markets, algorithms and sentiment can drive volatility. In private markets, the focus is different: patience, process, and performance. At Smart Modern Wealth, we focus on long-term positioning, not short-term predictions. So if you're exploring private equity, don't start with access. Start with alignment. Ask yourself, what are my liquidity needs? What's my return profile? What kind of investor do I want to be in 10 years? Because wealth isn't just defined by what you invest in. It's shaped by the discipline behind what you don't. If this gives you a clearer view of private equity, consider subscribing for more insights into portfolio strategy, private markets, and long-term wealth structuring. Smart Modern Wealth isn't just about better returns. It's about keeping them safe. You've seen private equity and private credit, but here's what keeps us up at night. One investor using these same strategies lost $3.8 million. Not from a bad investment, from one missing sentence in his paperwork. Watch this next.